Hi. So let's now tackle section C. Wow. Now, section C obviously has a high focus on income tax and corporation tax questions. The first question normally is known as a thinking type question, the 10-mark question. It really requires you to put your analytical hat or your analyst hat on. But let's dive into it and see what we could have done, in this area. Now, you're told here list four factors which indicate that Deborah should be considered self-employed rather than an employee in an organization in her engagement with Class Limited. You're told that you should confine your answer to the information given in this question, which I think was very important. So, Deborah is a marketing consultant. She's agreed to a 12-month project to rebrand the marketing strategy for Class Limited. She's given an amount there of 56,000, and Deborah has been informed that Class Limited plans to treat this as an employee contract. Wow. But she believes it should be a self-employed contract. So the project will start on 6th of April, end on 5th of April, exactly a year. It will be paid in installments, the fee, which is quite interesting, with each installment paid on successful completion of that part of the project. And Deborah has even chosen the option to outsource parts of the project to other consultants. She has the option to outsource parts of the project to other consultants if necessary. But Deborah will also work from her own office. She'll purchase a laptop for herself. Interesting. Although focused on the project, Deborah is free to engage with other clients and projects she should wish. Okay, so she's not bound to them. Deborah left her previous employment and has had no taxable income since then. Right. So these are some of the few points that we've been able to pick out from why she could be self-employed. We need exactly four factors. Each of them would be given zero point 0.5 marks. So either Deborah is taking on the financial risk since her payment will only come after each stage. So that almost sounds like a self-employed individual considering she's a consultant here. She's also not obligated to carry out the work herself. As you can see here, she can outsource parts of it. If she was employed, she would not have this option. She's also getting her own laptop. So as a result of that, she's using her own laptop to do this. And therefore, that in itself shows she didn't get any company laptop to work on. And she's also free to work for other companies. Usually for employed individuals, if they were to do this would be considered to be conflict of interest. But for self-employed individuals, they might have the freedom of being able to engage with other clientele. Now, explain how the timing of the payment of income tax on the fee from Class Limited will differ if Deborah is treated as self-employed rather than as employed. So this question just requires us to write down or to identify when will both actually be liable for tax. Now, as a self-employed individual, that date would be 31st of January 2026 for the tax year 2024-2025, okay? That's when the payment on income tax would have come in if she was self-employed. But when she's employed, this is deducted under pay as you earn and is liable every time she receives income. So she might end up paying it earlier because this could be computed and required to be paid earlier than before. So we don't have a specific date here, but it's just really important to appreciate that it is due as and when she receives income if she was employed. On the basis that Deborah is treated as self-employed and has no other income apart from the 56,000 fee, calculate her income liability and her NIC. Now, one of the things I might want to be a bit careful with is note 2, because note 2 speaks about a laptop used for business purposes. This is plant and machinery used for business purposes, of which we can claim capital allowances on. So I'd be a bit careful on that. And since it's the only asset we can see there, then it means that we can claim AIA on it, the annual investment allowance, which is you're given up to $1 million, to deduct. But since the amount here is only 2,500, that is what we'll deduct from the 56K to get the adjusted trading profit. And that's exactly what happens there. So since she's self-employed also, the NIC she's going to pay is class 4. And you can see there class 4, the rates are as you see there. Okay, 50,270 minus 12,570 times 6%, and anything excess at 2%. So as a result of that, we first get the adjusted trading profit, which gives us 53,500, and then we compute the class 4 NICs. Okay, where we have 5270 minus 12,570 times 6%, and you can see the figure there, while the excess is multiplied at 2%. So this is what our class 4 NICs are going to be. You base it based on the earnings, and that is after deducting capital allowances, or the profits after deducting capital allowances. Now, for the liability, though, we have the trading income now of 53,500. This is the only income that she has, so it becomes your net income because there's no deductible interest or any interest that arises from qualifying loans that you deduct from your total income to get your net income. So in this case, your total income and the net income are the same. Then with less your personal allowance, you get your taxable income, and then from there you directly get your liability by taking 37,700 times 20% and the excess at 40%, giving you 8,832. Now, from here, we are told to calculate the additional. I think for me, the part I'd be very careful with is that word additional, because it seems like we might have to compare it with what we got here of 2,327. It's as if we're trying to compare what would she actually pay if she was employed in terms of NICs, as opposed to what she paid when she was self-employed. So when she was self-employed, she should pay 2327. But if she's employed, we have to realize that she's now an employee, and therefore the only relevant NIC will be class 1 employee. As you can see there, the rates are 8% and 2% for the specific ranges we can see there. Now, as a result of that, we will do exactly that. Now that her earnings are 56,000. So since she's an employee, we won't deduct the 2,500 because as an employee, how would you even consider this? As a business, this is you'd claim capital allowances. But now that she's an employee of the company, you start to realize this can in itself be considered as earnings. All right, this 56,000 can be considered as earnings. And that's what we compute our class 1 employer NICs on. We compute them purely on earnings. Earnings in this case is your salary. So if she was paid 56,000 as her salary, that's what we would compute on, and that's what we've done exactly here. As you can see here, once I get my amount, I compare it to what I made with the class 4 NICs because I want to get the additional. How much more is she going to pay if she goes through the employee route? I do think a lot of students could have easily missed out on this because of the word additional. Sometimes someone would just do the right computation but forget to consider that. And if you're one of those people, just take note, okay? Just take note. Then we have the typical 11-mark question, calculating Vera's income tax liability. Wow. Now we have a lot of content here, a lot of things to consider. We can see here tax liability simply means we have to go all the way to the end, all right? And we can see she's employed by two different companies on two different days. We have 5 limited, we have 7 limited, and we have some other information here that speaks about dividends she makes. And we're also told of a personal pension contribution, which will be used to expand the band rates. Now, let's start off with 5 limited, okay? So we're told in the first sentence, Vera was employed by 5 Limited for many years, but she resigned from her employment. So on 30th of June, she resigns. And therefore, for that particular tax year, she's been there only from 6th of April to 30th of June, which is 3 months. So as much as we're talking about her annual salary being 72,000, we are only going to consider the salary for the 3 months that she worked for that particular company in that tax year. Then in the second point, we're told here Vera used her own car while working, and therefore you're told she traveled 1,400 business miles for which she received an allowance of 50p per mile. So she received from her employer, her former employer, 50p per mile on the 1,400 miles, and 50p per mile is 0.5 pounds. So we used the statutory approved mileage allowance to compute this, and we realized she received more than what she should have because by law, she's required to receive, for the miles that she's traveled, she should have received 630. But what she instead received from her employer was 1,400 times 0.5. So she received 700 pounds. So she received 70 pounds more than she should have by law. And that's why we consider that to be a benefit. Now, if she received, let's say 500, she received less than what she should have, this amount, the amount would have been, the difference between the two amounts would have been an allowable deduction, which would have been deducted from your salary. And anyway, as you can see, what we do with that 70, it's added to the salary figure. Now, for 7 Limited, there's a bit more. She joins 7 Limited on 1st of July, and she's there all the way till the end of the year, which is 9 months. So her salary is 90,000 times 9 over 12, because we're told it's a gross annual salary of 90K. We get 67,500. Then the second point speaks about and this is very important. Look, notice the dates. I usually tell guys, tax is like a beautiful lady. You have to be very careful with dates. She cares about anniversaries, birthdays, and things like that. Very important. So dates are key in tax. And you can see here, 1st of October. So this car was not fully used for a full year. It was used from October, November, December, January, February, and March. You don't count April because it's at the beginning of April that the tax year ends. Okay, so you only count full months. So we find those are 6 months. And then we're told she's given a hybrid electric car. Now, when you're dealing with hybrid cars, you don't focus on the CO2 emissions when computing their benefits. You focus more on the electric range that you can normally drive this car for, on purely electric aspects. So you find here 29 miles. If you opened the tax table, this was roughly around 14%. Now the car's a list price of 36,000, and we're told the private fuel was paid by Vera, so there's no fuel benefit. So we have 14% times 36,000 times 6 over 12. That's why we have our answer there. Then we have here 7 Limited provided a flat for Vera to live in. Look at the date again. They gave her the flat from 1st of July. Again, if you count the number of months here, that she's enjoyed that flat for. It's in the year, it's from July, August, September, October, November, December, January, February, March. Those are 9 months. So we have to put that mental note that we're going to be prorating both the annual value and the additional benefit by 9 months. Now, the flat was purchased by the company, so the company owns this flat. But notice they bought it in 2017, yet Vera enjoys it from July 2024. So you see, this is more than 6 years. And why is this important? Why do we even do this? I'm using this because if your employer provides you an accommodation, and then you find the accommodation they're providing to you was bought for more than 75,000 pounds, then that gives rise to an additional benefit. Like in our case, the employer bought the flat for 250,000, which is more than 75,000 pounds. So to compute the additional benefit, we have to get the cost of providing living accommodation minus 75,000 times the official rate of interest, which is 2.25%. Now, to get that cost of providing living accommodation is where you have to be very careful, because you have to ask yourself whether this house was bought more than 6 years before it was given to the employee as a benefit, or less than 6 years. If it is more than 6 years, we take the market value, which is our case. If it is less than 6 years, we would take the purchase cost. Now, please note, together with the purchase cost, you'd normally add any subsequent events or any subsequent improvements done before the start of the year, before you start the tax year, the current tax year. Now, if you take the market value, you add the improvements that are made from the start of the tax year onwards. So I usually tell my students, it's almost like matching. Purchase cost is a historical cost. So you only consider the improvements not done historically. Anything before the start of the tax year is what we consider. And then for the market value, since it's a current cost, it's a present cost, we'll only add improvements that you incur in the present. Okay, anything done within the tax year and as you go in the future. So you find in our case, because it was provided more than 6 years ago, we will take the 300,000 And we will ignore these improvements because these improvements would only be our historical improvements. They were done on 1st of May 2021, so they will not be added to the market value. Notice with the annual value, this is annual value means that's the value for 12 months, but this accommodation was only enjoyed for 9 months. So that's what we exactly consider 9 months. So we do there 6,500 times 9 over 12. With the additional benefit, we'll get the difference of 300,000 minus 75K. You'll get 225,000 times 2.25% times 9 over 12. And therefore you get your answer there. So you now notice, and we add that now to the accommodation benefit. Then we are told here, 7 Limited provided Vera with an interest-free loan. Wow. So she's getting a loan from her employer, but actually at no interest rate whatsoever. So for Vera, her benefit, normally when you're computing benefits for loans, you compute the difference between what they should have paid at the official rate minus what they actually paid. And in our case, she pays nothing. So 2.25% minus 0 is 2.25%. That's the benefit for her. That she gets an advantage of enjoying a cheaper loan, because she's going to pay at zero interest, while probably everyone else is paying at 2.25%. Anyone who is taking a normal loan could pay at 2.25%. So you see, for her, there's a benefit there because it's like an advantage she has. She can enjoy the cheap loan. And she's taking it at the interest of 20,000. This is the benefit, 2.25%, because that's, what she saved herself from. And we multiplied by 8 over 12 because this loan was purchased on or was provided on 1st of August 2024. Now notice I did not show the two methods, simple average method and strict method. And the reason is because if the principal amount, like in our case 20,000, remains the same amount all through the year, whether you use the strict method or the simpler average method, the answer will still be the same. If, let's say, for instance, Vera paid, part of this 20,000 during the tax year and reduced it to, let's say, I don't know, 12,000, then the answers might be different if you use the strict method and the simple average method. And if the answers are different, you should take the one that will give you the lower benefit. But in this case, since there was no change in the principal amount all through the year, you will still get the same answer. Okay? So you have here 18,070 from 5 Limited and 78,992. Okay, remember we're still not done with the question. We want to get the tax liability. We have dividends here of 1,500. So what do we do next? So you add the two incomes. You have your dividends, you less your personal allowance, you get your taxable income, as you can see. Remember, we also have a personal pension contribution of 6,000, which will expand the band rates. So we expand the band rates, and we only expand the basic rates because the total taxable income does not go past the higher rate figure. So we expand here, that's 7,700 plus 6,000, you'll get 43,700. You multiply that by 20%, and then you find the excess at 40%. Now with dividend income, the first 500 of dividends is taxed at 0 because it's considered under the dividend income nil rate band. So that's what we've done there. Then we multiply the excess of 1,000 because out of the 1,500, we've already taxed 500 at 0. So the excess of 1,000 is going to be multiplied at the higher rate of 33.75%. Please note there's a difference between the rate for dividends and the rate for non-savings and savings. As you can see here, the higher rate is 40%, but for them it's 33.75. Just don't mix that. Sometimes you find students doing 1,000 times 40%, which is it's an unfortunate mistake. Then here, as we end this question, set out briefly the content and purpose of the pay as you earn. Now, sometimes you might not really know, okay, and it won't hurt you. Flag, move on, or you might not remember. Just flag and move on. But if you know, jot down your 2 points. If you don't have the 2 points, probably you remember the content of the pay as you earn, but you don't remember the purpose, for instance. It's still fine. All right. So I bring in very short points there. The content is it just shows various pay and tax deducted up to the living date. Okay. But its purpose is just to ensure accurate tax calculations, especially when she's starting her new job. Okay, so I've just written it in one sentence. So when she starts her new job with her new employer, she can give them that form, and they can actually see how she's been deducted for in the past, and they can now ensure that they get their computations right in the same. I found this question very interesting because most times the student might not think too much about the advantages and disadvantages of payrolling their benefits, which simply means adding their benefits as part of their salary, okay? As opposed to treating them separately and dealing with it later. It's basically captured under the salary amount. So the benefit of that is that it's collected in real time through pay as you earn, which will reduce the risk of underpayment in the future because you can actually capture it immediately under your salary. When you're computing your pay as you earn, you're also able to consider both the salary and the benefits. But Vera will lose the option to spread the tax liability over the year because you see now, the fact that she's added it as part of her salary means she has to pay as and when she receives her salary. Unlike now, if she used the self-assessment method, she can choose when to pay. She can be able to spread her her liability more effectively across the year, which would help with cash flow. Okay, just one advantage and disadvantage. Again, if you didn't know this, it's a good place to learn. You can research more about it, but I'd just advise sometimes, such a question is very good, but if you don't know it, don't stress about it. There are greater marks in other questions, and I'd just recommend a student, move on. It won't hurt you to lose this. Okay, I think it was about 2 marks. It won't hurt you to do this. There are greater marks. Someone could spend so much time here and probably they'll score more in this 12-mark question. So focus on the 12-mark question, all right? Now, this question was lengthy. As you can see here, you're told calculate Darwin's taxable total profits. Quite long. And it's not the tax liability, it's just the summation or the addition of all the incomes this company has. So the first thing I might focus on primarily is the trade profits because I can see there's a lot of things here because I'm being told here, they have an accounting profit of 3.6 million. And you can see here the following income and expense items had been adjusted to arrive at that profit of 3.6 million. There's also a computation for capital allowances, so there's quite a bit of work here. So let's try and see it. So how would I compute this? So first and foremost, the trading profit is 3.6 million. You want to do adjustments. So I'll start off with depreciation. Depreciation is a capital expense, so we normally add it back. Loss on disposal is also a capital expense. Revenue expenditure is deductible, but capital expenditure is non-deductible for the purposes of adjusting your trade profits. So we find this is also added back. The entertainment expense, we will only consider the part that is not related to the staff. Okay, staff entertainment expense is what is deductible because it relates to the trade. Your staff are your internal, stakeholders, so they're within your business, and that's why I've separated them. I've captured what should be added back, and I still recognize the staff entertainment. I write 0. There's a power in writing 0. Sometimes you would find in different marking schemes, you're able to grab or get at least 0.5 marks. There was a time, I think last year, we had given up to 5 marks in one of the exams simply just by writing 0. Up to 5 marks, imagine in section C, spread across. Then we have here a fine. Fines, add back. We usually add them back unless it's a parking fine whilst you're on your employer's business. And then QCDs. QCDs should be deductible, but not from trade profits. They should be deductible from total profits. And that's why we add them back here, but we'll deduct them later on from the total profits and not from the tax, not from the trade profits. Then we come here to what we less. We are less in the bank interest because this bank interest received should not be considered as a trade income. Rather, it will be considered as interest income from non-trading loan relationships. We'll never have bank interest received in your exam. The examiner stated they will not test on that. So that means you will not get questions on companies that are in the financial services industries like banks and microfinance institutions, who would normally receive a bank interest as part of their trade. all the companies will be dealing with are not going to be in the business of giving out loans or things like that. So that means that we can't include this income as part of trade because it's not in your business to give out loans. So it's still an interest income, but it'll be captured under non-trading loan relationship. So we remove it from there. Dividends are also removed because we don't consider them as part of trade profits, nor do we even consider them as part of taxable total profits. Though there's one that will be considered under augmented profits, which we shall see. Rent is also added back because this is considered under property income, okay? Under property income and not under trade income. Then we have the capital allowances, and I give a working here. So how did I get that working? So we have here, notice how I present my work as well. It's very clean, very easy to follow. All right. And it's important for you to also ensure you make it easier for the marker to be able to follow through with what you've done. It's just that I'm not able to click on this, but you'll also notice I've shown my workings. Okay. So I don't leave anything to chance. Now, you'll find here opening balances. So please don't leave your workings on the calculator. Okay, please show how you got the sum of these answers. Okay, so if I click on the 3391600, I should see I've used a formula to get that final answer, whether it's equal sum, and then you're able to capture the cells you want to capture. Then you have here the opening balance. Let's come to capital allowances. So we're told here they had the following pool balances. The general pool is 1.25 million, which is also known as the main pool. And the special rate pool is to 13,000. You can write SRP, you can write AIA, you can use short forms as long as you understand it's not your own, formed short forms. They are actually used. So AIA, SRP, all those things, WDA, those ones are used. And therefore we will understand what you mean. Now, with the additions, which ones will ideally qualify for AIA? Both the air conditioning system and plant and machinery will. Cars are usually one of the assets that don't qualify for such. So you'll have that, you'll claim your AIA, transfer the AIA to the allowance section. Okay. Then we have a disposal here of some old plant and machinery. We normally take the lower of the disposal and the purchase because the lower amount will normally result to a higher capital allowance, and a higher capital allowance will reduce to a lower tax, trade income, which will eventually lead to a lower tax liability. So it's a good thing for you. Okay, so we usually take the lower so that the lower the disposal amount, the higher the capital allowance, because you'll see here the balance of 1,244,000 will at least now claim WDA here of 18% and 6%. 18% on the main pool, 6% on the special rate pool. If these balances were lower than they should be, then of course you won't claim as high, in terms of capital allowances as compared to what you've claimed now. So we transfer the WDAs to the allowances section because they are allowances, so that you can also get the maximum capital allowance together with the carry forward, okay, which will be utilized in the following year. Notice I then take this, I've labeled very well, working one, so the marker knows where we are at in our computation and how I got to arrive at that 741,700. Showing your workings is very important. Now that we have our trade income, we're able to then add it with the interest income, which was that bank interest, the property income, which was the rent. You remember the one that we deducted from trade can now be added to get your total profits. And the chargeable gain. So chargeable gain is another working. And we're given here a statement telling us Darwin sold a freehold factory on 12th of February 2025 for 510,000. The factory had originally been bought for 285,000, and they've already bought another small factory. So I can see a bit of rollover here, and I'd like to show you how to do that. So we sold it at 510. We have an indexed cost. See, I've added the indexation allowance within the cost itself so that I can get the indexed cost, just to save on time. And I'm also sure the index cost will not be greater than the sale proceeds, so I won't have issues of getting a negative answer and realizing that indexation allowance cannot create a negative answer. It can only reduce your gain to 0. But here I know for a fact our index cost is below, so I can just directly multiply as I have done. All right, this is simply done by adding 1 before the decimal. So it's as if you're adding that indexation factor of 0.047 into the 285,000. So you have here the total gain, and then the chargeable gain, or the gain, we call it the gain immediately chargeable. The part that will become immediately chargeable is the part you didn't, it's the proceeds you have not used in reinvesting in a new asset, in a replacement asset. So you see, we had a freehold factory, we spent 510 and we bought a replacement for 487,000. So that part of the proceeds you've not used or utilized is going to be charged immediately, and that's 23,000. That's how we got it. Now, the difference between 211,605 and 23,000, that remaining gain is what is going to be deferred to the foreseeable future. We call it the rollover relief. Okay. So anyway, once you get the chargeable gain, we get our total profits, then we less the QCDs. Now we've deducted the QCDs from their right, in their right place, which was basically from total profits. Okay, and that's how you're meant to do this question. So we have here 351,100 and sorry, 3,511,700. Then we come to the last question, I believe, that asks you calculate Darwin's corporation tax liability and then identify the due dates. It's important to know what you're being asked for. These are two parts of the question. One is the corporation tax liability, which we will get. So we have the taxable total profits of 3,511,700. I'm getting the augmented profits because the augmented profits help us to determine if this is a large company or not, and at the same time, the rate that they might apply on the taxable total profits. Now, to get the augmented profits, you might want to add dividends from companies that you're not connected with or companies that you own less than 50% in. For Ape Limited, we owned 100%, and therefore we don't consider the dividends in the computation of augmented profits. Now, I want you to note, we don't multiply, when we're getting the liability, we don't compute on the augmented profits. We compute on the taxable total profits. The reason why it's called taxable is because you're able to tax. So I have 3,511,700. I multiply by 25%. Why? Because in your tax tables, you will see if your augmented profits are greater than the upper limit of 250,000, you normally use the higher rate of 25%. Okay, and you can go check that out. So that's why we've applied that, and you use this rate on your taxable total profits. The next thing we ask for is the due dates. Now, for the due dates, we have to realize we're told somewhere here Darwin's augmented profits for the year in the previous year were 14,000. Now, I do think it's important for us to really realize that the profit threshold is 1.5 million normally, but it is reduced by the number of associated companies you have. Now, in this case, associated companies are companies that you hold more than 50% in. Now that means, that means you'll count both Darwin and Ape. Okay, this is like Charles Darwin, the historian. But you'll find here Darwin and Ape. Now, there are two associated companies, and therefore they're going to reduce your threshold from 1.5 million to 750,000. So if your augmented profits, which in our case was 3,518,900, is greater than the profit threshold, which in our case is 750,000, then you're considered to be a large company. And if you're considered to be a large company, you'll pay in 4 installments. The first installment, 4 quarterly installments. The first installment is due on the 14th day of the 7th month. Now, for us, the 7th month starts from the time your year begins. So their year begins on April. So you count April as the first month, then May, June, July, August, September, October. So October is the 7th month. You take here the 14th day. Also, how we get the quarterly installments is simply by quarterly amounts is simply by taking the corporation tax liability, which is 877,925, and dividing it by 4, because it's going to be paid in 4 installments, as you can see here. Okay, the other dates, the second, the third, and the fourth, is basically arises because you're paying after every 3 months. So if you count between October to Jan, that's 3 months. From Jan to April is 3 months. From April to July is 3 months. And that's how we get your answer from this. Right? So anyway, I really want to wish you guys the very best. I really hope you enjoyed this and you understood a few things that you can work on. Try to identify your mistakes, where you can improve on. Be able to pick up key details when you're reading long scenarios so that you don't get so stuck up in so much information, while you can break these long scenarios in smaller bits. Okay. Also, at the same time, if you didn't perform well, don't let that discourage you. It's just a moment to learn and to improve on. And therefore, you can actually be able to pick yourself up from this. Okay. You still have a few days to the exam. Polish on the areas of your weaknesses, increase in your strengths, and you will be good to go. All the best. I know sometimes you feel like tax has a lot, but I can tell you, you can enjoy this. The more you practice and practice effectively, the more you will get it and thrive. Okay? All the best in your final exam.